I'll get us started. We're at the 5-minute mark. Thank you everyone for joining me. This is class 3, commercial real estate basics. We're going to talk about the actual asset classes this time around. And then the next time we're actually going to go a bit more into the math. This is more of overarching concepts, but also how to actually find real estate that fits the right market that you're looking for. And different tools that I've used in the past. So this particular portion involves the M part of the EDM method, which is experience deals and markets. Right now, what we're looking to figure out is how do I identify location, my market, my asset class? How do I figure out, where to go buy? And so one of the things that I find the most important is this concept of picking the right city, right? Location. So this is the metro level at a larger overarching level. And a lot of people focus on this number, which is population growth. But what they don't realize is population growth isn't the most important number when it comes to commercial real estate. Commercial real estate, it's about how much rent can you charge? How much income can you generate, right? And population growth is a precursor. The more people who move to a city, that increases the number of jobs that is required. And then the more jobs there are, that hopefully leads to more, or the more job demand there is, hopefully that leads to wage and inflation that eventually leads to higher rent within that city. And so for a landlord or person investing in syndication, your goal is to figure out, how do I maximize my rents? And you start from the base level, which is the city even growing at all in terms of population? You'll see very quickly here, based on the US Census data, the fastest growing cities with more than 50,000 people are Georgetown, Santa Cruz, Kyle, Leander, Little Elm, Westfield. You're going to notice here, especially if you guys are used to looking at the Austin Metro, Georgetown, Kyle, Leander, these are just cities that are in the Austin MSA. New Braunfels is one of them as well. Right. And if you actually looked at the overall fastest growing metros, Austin's obviously number one by percent, by a significant amount. And so it doesn't surprise that a lot of the largest cities in terms of growth from 2021 to 2022, because that's census data is very slow, Austin is still kind of top of mind for that growth. Then you're also going to notice another very popular state, which is Florida. You're going to see a lot of these as well. Northport, Cape Coral, Lucy, Conroe is actually in Houston, Arizona. So a lot of these cities are ones that people already know about. And that growth only accelerated during the population boom that was spurred on by the pandemic. And so some of it's probably slowing down, right? Any economic downturn, people get more scared to invest in moving to a new city. And so, that's a risk that people end up taking on if they don't know for sure that they're going to have a job in that city. So that's something you have to be wary about. Growth might not always be there, but in particular, at least for the last decade or so, this is more or less kind of followed the same trends. So, all right, then you care about wages and wage growth and job growth. So how do you figure out what job growth is? Well, there's a website called departmentofnumbers.com and employments, and you can track the different metros. Now you have to be cautious. I ranked it by what is the biggest 1 year jobs percent change. And Midland, Texas grew the most. But the thing is with Midland, Texas is that they are a oil town. So they are a boom and bust city. Oil's good right now. Of course, Midland hires a bunch. But the moment oil prices drop again, they just clear out. Rent actually falls in this city, unlike other ones, because it's so tied to a cyclical industry like oil. And it's very important that you eventually have economic diversity, which is what I'm going to talk about as well. And so you'll see here, though, a lot of these cities, again, Texas and Florida, you're going to see this very often, that these metros are going to outperform many other cities and states. And that's why they've been so popular with investors, right? And these are the base metrics that you care about if you want future rent to grow, if you want future prices to grow, right? But this list, as long as you have positive job growth, that's what matters, because job growth means growth in wages. And wages leads to being able to charge higher rent. This is the Bureau of Labor Statistics, it's the percent change in weekly average earnings over the last year, not seasonally adjusted. And so you can kind of follow along and see where the wages have been growing year over year from April 2022 to 2023. And right now we're starting to see a sea change of things where, yes, maybe Texas and Florida grew the most at the beginning, but now we're starting to see some of the pullback on those cities where maybe wages grew too fast or things are a little difficult now to maintain. And we're actually seeing California start to increase in wages again. And so that might be a future precursor to seeing rent grow up. So that's interesting to know. But to be fair, 2022 was also probably a low period for California wages because that was also the beginning of a lot of those layoffs. So you have to be cautious. That graph that you're looking at, if you only look 1 year back, you might not see the full picture. So, and then finally, what are the actual cities that are growing the fastest? You want this to be positive as well. And you'll see very evidently that in the last few months, the past 3 years, all the cities that have grown the most have been, Tucson, Miami, Orlando, Phoenix, Jacksonville. Florida has pretty much taken the cake in terms of a lot of these past growth metrics. But what's happened recently is the actual rent growth, the numbers that we care about in terms of that income that we can generate, it's starting to slow down. And what's been happening is that the cities that didn't explode, Boston, Providence, Chicago, these like Midwestern or Northeast cities, they're still carrying on. They're continuing to beat out now what Phoenix used to do because they've been this slow and steady uphill trend instead of being more of a boom and bust. And so it makes sense to not always follow the crowd, but in this scenario, people who invested in the Midwest, they're going to still see that steady growth. They don't have to worry as much about capital influx coming in and coming out because they can still maintain the two biggest things that keep housing prices up: incomes and rent. So cash is king. I think I've said this before. Don't buy in a city if you can't afford to cash flow. What this means is rent has not really ever gone down like wholesale. It's been hurt and it's gone sideways. But if you look at this graph in 2008, 2009, the biggest housing recession of all time, rent went sideways when prices dropped by half. So what this tells us is that cash flow is king. And if you can survive into the other side, you're not going to be forced to sell your property. Given the amount of unemployment and all the economic issues that happen, somehow rent stayed flat, right? People downgraded from maybe A-class buildings to B to C. And, rent is food, it's water, it's a commodity that people need to survive. And even if you get foreclosed on, you need a place to live, right? And so if you bet on appreciation in the city, it's a bit of gambling. But if you have enough cash flow to keep yourself at the other side, then you're going to be fine. And people complain all the time. They're like, I can't cash flow in San Francisco. Maybe you shouldn't be investing there. You can do flips, but maybe not long-term holds, right? I've said the same thing actually about Austin. If you can't hold for cash flow, we'll just put more money down. There's this guy that I know, Mark Henneman. He was the showrunner for Family Guy for a long time. He is a pretty big landlord. He put 50% down on the buildings he would invest in LA. And that's how he did it. But the appreciation and the other stuff made out well enough for him that he's now, worth some 8-figure amount of money. But he got to there by putting 50% down. Obviously, it's a lot harder now. He started way back in 2000, but that's one of the things that you have to think about. If you are in a city that has a lot of growth and you can't afford a cash flow, maybe you have to be okay with putting more money down. That'll keep you safer because when a downturn does happen, you're not forced to sell. And that's usually the worst time. It's all about trying to survive to get to the other side of that downturn. Economic diversity. Now, Detroit is the biggest example that I know. I mentioned Midland, Texas earlier. Oil cities are the modern version of that. But the even more modern version is tech cities. Detroit is a city that has lost 60% of its population. The car boom ended in the 50s. And with the arrival of Japanese cars that more or less created the American car industry, more and more people just kept leaving Detroit, right? That's why it is the way it is today. People make fun of it because it has this infrastructure. It has this amount of buildings and this like largesse that was designed for a city that was supposed to be 3 times its current size. And why is that the case? Because it was bigger at one point, and the American car companies lost their mojo, and a whole city went down with it. And so that's kind of what happened to San Francisco. In the last 2 years, San Francisco's more or less fallen, one of the most fallen cities in terms of prices. Rent is the least amount of growth because they over leveraged themselves on the tech industry. And when the tech industry started to suffer, so did the real estate. They weren't able to balance it out with all the other income streams possibly that could have helped stem the tide. And so, sure, San Francisco, some properties are back up because seasonally, this is when it's most competitive. And yes, I've heard plenty about people bidding over asking now in San Francisco. Great. But a lot of those properties are still down 20% from last summer. And I know because I was given some deals that were 40% below what they appraised only like 9 months prior. But I don't ever buy in California. So like I passed on it. It was also like a C-class Oakland building. And so you have to be very cautious when you buy in a city. Do they have other economic drivers besides one industry? And so anytime there's a city that more than 20%, at least 15%, I would say even, of the employment is dependent on one industry, which you can look up from the Bureau of Labor Statistics. You want to be a little bit cautious about that and the longevity that you think that industry might have. And then finally, competitive advantage is the big thing that you want to have. Do you know somebody in that town? Do you have access to deals in that town? Do you have some sort of machinery that other people have no ability to compete in, right? One of the things that I've pitched in the past is, at least for when I talk to other investors, is, what is the thing that makes you stand out? One thing I hear a lot is, oh, we just own a lot of property in this area. And so we have a lot of advantages. Obviously, owning and having a lot of real estate for a long time in that area, it's a pretty good benefit. My pitch that I've given investors in the past, I consult for the largest real estate fund in the world. And so between that and the data that I get access to, combined with advanced machine learning techniques, I get a lot of benefit when it comes to early access because I see where the money's going. I actually help conduct it because I get to build those machine learning models for them. And so that's been something that I've said is a competitive advantage, but anyone can have a different kind of competitive advantage, and just a question of how does one person do better than the other. One of the biggest issues I hear often when people are investing is they're like, well, I want to invest in Austin. I want to invest in Florida. Good luck. The whole country did, and so you have a lot of competition pushing prices up. And so it's very hard to find a competitive advantage there. But you also don't want to be in a place where no one is buying. For example, like Cleveland, it's popular for investors. And so if you do buy, make sure you knock at least 30-40% off. That's what we did in Chicago. We bought day one, knocking 40% off what the price should be versus what other people's comps were. In a city that's unpopular, your advantage is buying cheap, not hoping for future growth and just relying on cash flow alone. Value add is much more important. And so you have to figure out what city you're investing in and then what your advantage might be versus other investors. Now, how do you identify neighborhoods and what's a good neighborhood? City data is one of my favorites. With city data, you can look up the median household income, but you can also see how much the household income has changed percentage-wise since the year 2K. The more purple it is, the more the growth has been, right? And so this is the city of Jacksonville. It's a city I invest in. We have an apartment complex here, and it kind of in this area. And you can see like, hey, the path of growth, it's almost all outwards. A lot of cities will look like this. Some won't. I know in Chicago, it tends to follow the north side, not so much the south side, because that's where most of that boom has been over the last 20 years. With Jacksonville, you can kind of see that the growth is heading further and further south, and especially along the waterfront of the river, not necessarily along the ocean, right? Which is the prime Class A area. You might have some nice beachfront properties, but those don't grow as much in terms of rent. And so that's something that you want to consider when you are buying properties and selecting the neighborhoods once you've picked the city that you think you have an advantage in. And the city data is one of my first places I go because It's very interactive. When you click on it, a bubble pops up and it shows you the actual amount too. So you don't just have household income, you have the economic breakdown. So the actual incomes, you have poverty, you have some crime rankings, you have a lot of other features that you can use to figure out, is this the right neighborhood for the city? Same thing with Neighborhood Scout. So you can see the safest neighborhoods in Jacksonville. The darker it is, which is the downtown area, the higher the crime. And you can see like this area tends to be pretty high crime. And so being on the south bank of Jacksonville is a bit better, for example, than the north. And if you are in the north and in the west, you want to be further out into those suburbs, right? Neighborhood Scout also has economic data, school data, real estate data. And then finally, Spot Crime is an app that I use as well to track. This symbol means shootings. This is not very good because shootings means people don't actually want to live there. It's much higher chance of crime. However, these punches means assaults, which, especially if you're near a bar area that's kind of hip, like a downtown, you're going to see a lot of those. So I've started ignoring those sometimes. It's hit or miss with this data. You just want to be cautious in terms of arson, though, and of any shootings. Those are the two big ones that I check for when it comes to crime. So in terms of assets, why multifamily apartments? I think I said this earlier, people always need a place to live, and your financing is actually cheaper, like 1 to 2% compared to if you were to buy an office building right now, especially. You also have lower down payments, like commercial buildings. Even when the interest rate was cheap, trying to buy a retail building, you would at most could get away with, when you were trying to buy a commercial building, at most you might get away with 35% down. Now it's, north of 50, 60%, especially for like a bridge loan. Whereas with multifamily, people are willing to go with a lower income multiple because it's a safer asset class. And the thing is, you find a lot more professional vendors. It's easier to find, right? So for example, if you're working in manufactured housing, it's still housing, but you have to find a specific PM for that. Same thing with self-storage, right? Chris Tao's a partner of mine. He has his own criteria for identifying locations for multifamily. He wants them to be close to large airports, right? Direct flights, companies moving in, right? You don't have that unless you have a large airport with direct flights. And then for him, he also cares about the importance of the school, which improves the tenancy and the quality of the tenants, which translates to being able to generate higher rent long-term. And so, multifamily is very popular. It's a commodity. It's a thing that people need to live. And so that's why it stayed so popular. But there's other syndications and other asset classes that are quite popular. I'm going to go over some of the basic ones in real estate, but they also have syndications for other asset classes, such as I've been asked to invest in, crypto syndications. I've been asked to invest in ATM syndications. So there's more than one way that people will raise money for these projects. You just have to be cautious and hopefully know the asset class you're trying to invest and diversify into. So retail suffered quite a bit recently, but it's actually started to improve quite a bit. What happened in the last 10, 20 years is the boom in e-commerce. And so any tenants that are service-based, like you want a small strip mall, ideally, with like nail salons, laundromats, businesses where people have to show up, that is typically still safe. But clothing businesses, those are some rough tenants, right? Same thing with big box, like Best Buy, et cetera. They've gone out of business because the internet more or less has made it significantly easier to buy online. And so these brick and mortar businesses are having a hard time competing, but that slowed down actually post-pandemic. Now that people are trying to get back into stores and enjoy that brick and mortar experience. And so it suffered a lot, but a lot of that retail stuff has actually gone to the wayside and been replaced with other commercial real estate that generates more money, dollar per square foot. Now, office, if you haven't been following commercial market recently, this is suffering quite a bit. There's already a lot of foreclosures. And the thing you have to understand is retail, office, industrial, especially hospitality, like hotels, no one actually needs those, especially in economic downturns. And so what happens is the income and the cash flow, the rent that's generated, it's riskier. than multifamily. And that's why, commercial real estate typically is traded at a lower valuation for the same amount of income you might generate for a multifamily building. So, but office, I don't know if y'all followed, there's a building in San Francisco that's lost 80% of the value from when it was built in 2019, right? That's a pretty big headache. A lot of large funds are just handing the office back and just saying, take all my down payment. I don't care anymore. The loan's your problem. There's a common saying, especially in the large real estate industrial space, if you owe the bank $1 million, it's your problem. If you owe the bank $1 billion, it's theirs, right? So, so that's office and retail. Maybe it's a buying opportunity. However, I know people say they want to convert office into multifamily. It's also incredibly difficult. You have to think about it from the perspective of building in all the necessary utilities. If you have an office building, one floor might have 2 bathrooms, right? So what can you build? A dorm at that point? And if not, then you're like, okay, well, this 40 floor office building, are you going to just replumb the whole thing, right? And then you have to add in new heating, ventilation, and air conditioning because each unit might need their own ducting system, right? And so once you factor in all those costs, really the only way you can convert is having a really old office building. And at that point, you're just buying it for the shell. You're not even, you're not saving that much money. And so I saw a study on this. Most office conversions to multifamily were buildings from the pre-1960s, right? And they're usually mid-sized or shorter. You're not going to turn a high rise into a full apartment complex. It's very hard to fill up an entire dorm tower of people. Although I would want to see what that looks like if someone were to take the risk on that. Storage self-storage had a great pandemic boost. A lot of people moved, so they used it to put stuff, but it slowed down quite a bit. Rent is down year over year for self-storage at the moment. It's still, I think, a decent asset class. I just don't understand it that well to comment on it. Industrial, huge boom in the last 10 years. Basically, we've had this huge boom in industrial and warehouse and in particular shipping companies because of the e-commerce boom. The places where retail suffered, industrial picked up on. And now that we have a bunch of onshoring with the conflict with China, you're starting to see a lot of companies put more and more business back in America. A lot of them are headed towards Texas and Florida because the cost is lower and it's easier to ship. And so Houston in particular has been benefiting from this. For example, in terms of the industrial onshoring, Houston as well has had the ability to source all the oil. That's where it all goes through. And so a lot of the chemicals, the products, the industrial portions that you might put in a factory, they're all in Houston. So, it's actually a pretty great location if you want to invest in manufacturing industrial in America. And then finally, how do you look up assets classes for different for different stats? Well, your brokers are going to be the people who find them for you. That's companies like NAI, Franklin Street, CBRE, and in most cities, like 4 or 5 of these brokerages do 90% of the transactions. It's very much, an old boys club. You have to break in and figure out a way to convince one of the brokers that, hey, I'm a friend and I can close, right? This has been something that I mention a lot to people, which is that it's not, when people say off market as well in commercial real estate, it's not actually off market. Almost all of them go through brokers. It's just who has a better relationship with the broker, so they get a first pass at it, right? And so in Jacksonville, we have 2 of the brokers, for example, in our back pocket because we bought through them before. However, the other 2, 3 brokers, we don't really have first pass access to, right? And so that's what makes it hard. But those 4 or 5 brokerages, they control most of just multifamily. If you look at industrial commercial, that's a whole nother set of commercial brokers that might be the top players in town. And so that's what makes it kind of fun, is like eventually having to build up your repertoire and figuring out who can I get on my side. And the only way to really do that is do enough transaction volume or partner with somebody who does a lot of transaction volume. And then finally, of course, local property managers know way more than you as an individual might investing out of state. If you guys can't see this chart, this is the occupancy of offices. And right now, Houston, Chicago, New York are at the top. And then San Francisco and some of these tech companies are near the bottom, right? And so the more tech friendly the city has been, the harder it's been for these offices to convince people to come back. And this is something people have been talking about for a long time. And we're just seeing that play out now in the San Francisco office market, the LA office market sort of cratering. So this is a way to describe the class of the neighborhood you're in. I've said this before, craft coffee is class A, right? Those are your named coffee stores that are unique. They're not franchises. Whereas class B is Starbucks. You'll see those typically in nicer than most neighborhoods. Class C is a McDonald's or a Dunkin's. And then class D doesn't have coffee because there aren't really jobs to go around where people need to drink coffee in the morning. And then you also have to consider when you're buying that building and in that market, what does the weather look like? And that will affect the rest of the amenities that people care about. In Chicago, we need parking that's covered or garage. Like no one wants to scrape ice off of their car and park on the street, right? And so that's a huge amenity if you can do it. But by that same metric, because it's so cold, washer dryer, huge. In-unit washer dryer, people will easily pay like a 20% premium on rent for, not 20%, but maybe like an extra $100 to $200 a month. And then if you're in a sunny city or one that's pet friendly, dog parks are huge. And so, when it comes to considering what amenities you need, you really do have to think about what does the weather look like? What is it that my tenant demo looks like? And that depends on class A, class B, class C, and of course the actual temperature. And so when I look into this and I ask myself, what are the risk factors? Location is key, right? But also age. So if you're buying anything, you might make sure you want to ideally buy something that was built after the 70s. What you end up encountering in terms of risk is older buildings tend to have galvanized plumbing. Galvanized iron plumbing only lasts about 50 or so years. And if it was built in the 70s, guess what? It's been 50 or so years. And so they're more prone to cracking, they're more prone to leakages, and they also start eroding and turning the water red if they don't run the water for a while. And so galvanized plumbing is extremely expensive, but these are big, major factors that are expensive, but people don't appreciate because your tenants aren't going to pay more rent just because they have galvanized plumbing, right? This is a capital expenditure that you have to eat the cost of, but you don't get higher rent for it, right? You might be able to sell a little more to the next syndicator, but you're not going to be able to sell, more rent because, hey, this building has updated plumbing, right? All that matters is that the plumbing works. Aluminum wiring is another issue that people encounter. So aluminum wiring, same issue, 50-year lifespan. And what we realize is when you cool heat it for decades, it increases the risk that this thing sets on fire and burns the building down. And so what most people have to do is pigtail a lot of these electrical systems to prevent those fires. And so that costs money to do. And tenants aren't going to pay you just because you've updated and prevented fires with the electrical system. They just want it to work, right? And so these are just risk factors you think about in a commercial building. Do people pay more for it? No, but you still have to do it. That's what you'd ideally avoid and have the seller do at some point. But 70s buildings, you have higher lead risk from lead paint. So, ideally you're not going to use plaster, but if you do, that's going to be a lot of work replacing it with drywall. Mold risk, right? So if you have an older building, you're going to have more leaks. You're going to have more historical issues with water. And so, there's likely undiscovered mold risk behind those walls because you have more time for it to build up. Don't forget, older buildings tend to not have like a vent, for example, in the bathroom or proper HVAC. Well, what that means is you can't really dry out the unit enough so that it builds up moisture, right? That's why when you turn on the fan in the bathroom, it usually is linked to a light. And by doing that, because you turn on the light, the fan pulls out the moisture, preventing mold buildup in your bathroom. But you can't necessarily do that in an older building that doesn't have the electrical access. So you have to reinstall it yourself, right? And so that's what I meant by mold risk. Usually it's more an issue of, can this building remove liquids and humidity? And most of them don't do that very well, especially if they're older. And then finally, flat roofs, asphalt. Flat roofs, it's kind of obvious. It's more likely to pool water over time. And so your roof is going to go bad faster. Cracked asphalt, it's these are just big expensive items that people want at a bare minimum, but they won't pay more for you to fix, right? And so these are things you ideally don't want to deal with because, and if you do, just like factor that into your costs, but know that doesn't boost your rent. So does size matter? This is the big question. Yes, especially for GPs. It's way more scalable. It really makes a difference once you hit a number where you can hire a full-time property manager to be on site. Because most property managers, especially single family, they're between you and like 20 other clients because they need to make a living also. I don't blame them. They can't be fully focused on you because they're trying to eat also, right? If they only focus on your building, they wouldn't be able to, survive on that alone. For LPs, that makes it easy for you to be entirely hands-off because whoever the GP is can focus on just actually taking care of and making sure that whoever's the property manager actually watches over that building. And then watching that PM like a hawk is part of the job of an asset manager and for them to do well. And so why is this important in particular? You can see very quickly here, around 150 units is the marker they used. It's a random number they just picked, but you can see very quickly here that properties with less than 150 units have a higher expense ratio. And what does that mean? It just means their costs go up because you have a smaller building. That's it. Your maintenance goes down once you have more units. Your cost of leasing goes down when you have more units. These are pretty basic principles, right? The more you go, the cheaper it is for you to wholesale products that you would otherwise have to deal with on your own. And so now that being said, I mentioned this earlier, value add's important as well. This gives you extra protection during your downturn because there's always going to be a downturn, but there's always going to be that return back. I say always, in like quotes. It's historically what's always happened. However, the point of value add is in an apartment complex, you're increasing income, you're increasing your rent. So your cash flow is also better. And so this is essentially the same thing as if you flipped 100 homes all at once, right? And so that's why people care so much about value add. You've increased the value of the building. So if a downturn happens, it might just go back to where you bought it at. And your income's up so you can more easily survive through that downturn. Now, the issue though with downturns is less leverage, right? You can't borrow as much. I mentioned this earlier. I used to be able to buy an apartment complex and put 25% down. Now, if you want agency debt, you might have to put 40, 50% down. You have to work twice as hard now because you put less money down, or you put more money down and you're getting the same return out of it, right? And so at the same time, this is why it's so important where cash flow is king. As long as you can generate income, you don't have to worry as much as that person who's forced to sell at a lower price because of that downturn. And so when that person is selling, which you're going to hear a lot of in the next year or so in terms of struggling syndicators and whatnot, they're selling because they need the money fast. And usually it's because they don't have any other option but to sell it. They probably don't have investors who trust them enough for the refi. They don't have enough money to pay for a rate cap. They have limited options when it comes to exiting this project outside of selling it at an inopportune time. The other thing people sell, personal connection. And maybe you have knowledge that someone else doesn't know about the building, like maybe a new development coming down the line. That can lead to a good return because the seller doesn't realize that. So you've arbitraged knowledge, right? And so this is a harder thing to measure, but this is sometimes what I see as well when I ask, hey, why are the sellers selling to the sponsor who's running the project? And if they give me a good answer, that's even more of a benefit to invest with them. And then finally, the big one is why hasn't the competition bought it yet, right? And if they haven't bought it yet, is it being bid on, right? Is there someone else that they have an option for? And my preference is hearing, hey, no one else is actually looking at this deal. It's only us. I know this person and they're running out of money. And so they need to move quick and they don't have any other options. And so we have to buy this as quickly as possible. That to me is usually like all the flags that I would think of when I'm looking for a deal. So that being said, I'm going to finish this up with a case study. Starting at San Marco is one of the buildings we own in Jacksonville. So you can see right here, I'm going to pull up the neighborhood in city data. It's this really purple area / this whiter area, a little bit higher crime. We are on the other side of the highway for that. And so the income has gone up quite a bit since we bought, income's gone up quite a bit in that neighborhood that we bought in since the year 2000. And same thing, we are kind of on the edge of some of this high crime area, but it's a little less purple. But we're still kind of surrounded by other places that have high crime. There's ways to figure this out. Often the numbers aren't always exactly correct, but we are kind of in this range where we're safe enough. We're like in the middle. And then, if you check the spot crime, recently there was a shooting. It's on this other side of the highway, like I mentioned. So this side was the one that had lower income. This side up here is actually really bougie craft breweries, great location. Whereas we are kind of situated somewhere here. It actually prevents a lot of flooding, which is beneficial, but it also means like we're kind of cut off sometimes from that future gentrification growth. Although we did see a lot of rent growth and development in that area anyways. So we bought the building. We were like, this is a good enough neighborhood, and we like multifamily. So we were doing value add. We pushed income up. And so when we bought it at 12 million all in, we are now able to sell it at around 19. From according to the January 23, this is when we made the presentation. I should update this number soon. It's closer to 18 now. It's fallen a bit. But the SA man value that we got from our lender told us that we got it at 19 million. But again, like I said, it's probably 18 nowadays. And so we are able to pull the money out for a potential profit of around $7 million, right? And so this project kind of followed those principles. And a few of the big things we did, like I mentioned earlier, we found the right market, right? We were trying to be smart. Hey, where is a market that's popular, but people haven't really entered yet? Jacksonville was that for us. So dollar per door was very cheap compared to other places, despite it also having a lot of those Florida boom trends, which at that time had already started happening. Like Orlando was booming, Miami was booming. And so we just picked a less popular city, but in that general region that was still doing incredibly well. And looking back now, it's like, oh, there's the biggest rent increase, Jacksonville, right? Roseville, Sacramento is actually also booming. It's one of the biggest beneficiaries of COVID. What happened was all San Francisco is basically Class A, like given the prices. So when people left, they were like, well, I want to find something cheaper with more room. Sacramento was a huge beneficiary of that. And so that's why their rent has gone up quite a bit as well when people went remote. So we had a great rock star property management team. This is what I meant when I said, ask your local vendors, what should we do? We went with somebody who our partner had already partnered on for like 3 other buildings. We're like 25% of our properties, I want to say, they manage about 1,500 units. And so that gives us a lot of wiggle room with, it's a smaller property management company, but we have a lot more sway with them. And so that was our competitive advantage. It was a really good property management team that, we kind of have a chokehold over because our partners own so many buildings with them. And then finally, value add. If you fix the problem, that's how you make money, right? We picked some low-hanging fruit in terms of rehab on this one. We didn't spend that much on the renovations. Most of us focused on exterior projects. And so we were able to save a lot of money on that and focus just on the exterior reno, not so much on the interior, because the last owner had done a lot of that work already. They'd actually already swapped out the plumbing, right? And they'd already swapped out a few roofs as well. We started to do some work ourselves, obviously, like the HVAC, a lot of those units ended up failing. But we saved quite a bit of money on the plumbing, and then they had already done a lot of the electrical work as well. So that's it. I'll take questions for now. Anyone got questions about identifying markets? And general commercial real estate basics. This Google Sheets import also is working a little wonky. The format isn't exactly perfect when we transfer it over, so apologies about that. All right. Well, if no one else has any other questions, we're done for tonight. I'm glad everyone else was able to join here. Hope you guys have a good rest of your night. And let me know if there's anything else I can answer for y'all. All right.